if this was working, that would be one thing. But it's not. It's been a failed financial experiment, a failed financial system, and this is why we're not seeing people become more financially independent. This is why we're seeing people work so hard, take all that hard work, and set capital aside in something they don't know or understand, which is highly speculative and risky, and then getting to the place where they don't have time for the money to grow anymore because now it's retirement time, and they live a worse lifestyle than expected. That's not a retirement dream. It's a retirement nightmare. And you know the best way to end up with $1 million in the stock market. You start with 2 million or more, right? Like, that's just the problem with this whole thing. And then they tell you that on average, it's earned 10% since 2000 BC. You know, it's like average, like, let's say today I get in my little Venetian hotel and there's 2 shower heads, and I turn one to cold and the other one to scalding hot. On average, I'm at a warm temperature, but in reality, I'm miserable as hell, right? It doesn't really work that way. That's not how the world works. I mean, let's just do simple math. Let's say that you have $10,000 and you're in 100% on it. Who knows what that grows to? 20,000, right? Now, if you lose 50% the next year, now what is it? Back to your 10,000. So that's a 0% actual return, right? Actual return. Worse than that because they took their damn fees no matter what. But it's a 0% actual return. But anyone know how to just do quick averages like math, right? So if we had 100% the first year, Philip, we subtract 50% the second year, that's a positive 50%, right? Over 2 years, divide it by 2, that's a 25% average return. This is why no one's getting ahead in the damn stock market. It's all a bunch of crap. We did research. Since 2000, the US stock market, adjusted for inflation, has only done 9%. Total, not per year. Total. 2000 to 2015, one thing that's important to note is when we adjust for inflation, the stock market did 8.7% combined from 2000 to 2015. So that's what it's supposed to be doing per year. So yes, there are moments where we have big run-ups, like when we look at, from 2012 for a few years, or we look at, what's really happened in the last several years before 2020. Absolutely. But will it sustain? Is it sustainable? How could it be sustainable? Like, these are just questions I want you to be informed as you invest.
Let's go through market fluctuations. The first financial services firm I ever encountered convinced me to put my money in the stock market. I was 18 years old at the time. One illustration I was given showed a continuous 12% annual return, which they said was conservative. Now, why in the hell did they do this 12%? Because they claimed in 1998 that the stock market had averaged 12% since 1929, okay? Now, they were really about this you're in it for the long haul myth. Why that's a myth is, well, let's illustrate it. They showed me ending up with a fat nest egg at retirement age with a relatively low monthly investment of like $70 a month. The company also showed me what it would end up with if I had a continuous 18% rate of return, which is illegal, by the way, but because in the 90s, people thought the market was just always going to go up, they thought it would be fine. Now, in 2020, this seems absolutely ridiculous. But at the time, the 90s had inflated everyone's expectations. As an 18-year-old, I didn't know any better. They had to show me that on a separate calculator to show 18% because the software that the company put out wouldn't show those illustrations, right? The industry actually has laws to prevent financial services firms from legally illustrating more than the hypothetical 12% annual return, which is still ridiculous and inflated. Because when people look at the 90s, okay, the 90s, I get why they thought that. But if we look at from 2000 until, before the downturn of 2020, it's been more like 6% appreciation. So aside from the illegal tactics, their approach was fundamentally flawed. Financial service companies overlook that if we insert just one negative 12% annual return into the equation, in the time frame of that investment, the entire computation is thrown off literally by hundreds of thousands of dollars. It gets even worse when we replace that continuous 12% with the actual historical performance of the stock market. I'm going to do all this for you, okay? So why do retirement planners fail to consider and illustrate the possibility of negative returns? Well, the answer is twofold. First, most of them were not trained to incorporate negative returns into their calculations and may not realize how dramatic the effects can be. Second, even the ones who do realize this concept, well, they don't want to lose a sale by showing dismal numbers. Optimism, even unrealistic optimism, brings in more customers, all right? So because most of us labor under false information and all these financial myths, we get excited about the positive numbers and tend to think these calculations actually represent reality. So let's look at the numbers. In my book, Killing Sacred Cows, which I'll make sure you get a copy of, no charge, on page 74, I actually put together a chart. Now, this notion of, Roger Ma saying, look, if you're 20, you've got 40, 50 years before retirement, so you've got time. He's not taking into account what's called opportunity cost. If we insert one negative 12% annual return over a 30-year period, the entire forecast is thrown off by so much money. So, Roger, good luck with planning on retirement needs in that scenario. So let's use $100,000, and you can follow along with interest calculators or future value calculators. I downloaded one for free on my phone to kind of validate this that was in the book. If you had $100,000 at 12% over 30 years with no tax and no fees, it grows to $2,996,000. That's pretty cool. That sounds pretty exciting. But what if you had a 12% loss in year 10 instead of a 12% gain? It turns out that you only end up with $2,354,000. Now that's still a good amount of money, but that one negative year was a $642,000 loss. Yeah, $642,000 less. Now let's use the actual return of the S&P 500 after 3 down years from 2000 to 2003. But we're including the best decade ever of the 90s. With that, the money ends up being more like $1,250,000. That's quite a bit different than $2,996,000, right? It's more than 50% off course. Look, here's the big point here. It doesn't matter if you lost that 12% in year 1, year 10, year 15, or year 30, if we're talking about a lump sum $100,000 investment. All of the time, it still has a $642,000 impact. You may be asking why? Well, sure, in the first year, you'd only lose $12,000, right? That doesn't seem so bad. But now let's take $88,000 and run it at 12% for 29 years. $88,000 only grows to $2,354,000 because you don't have the gains on the $12,000 over that 29 years. That's crazy. So it doesn't matter if it's year 1, year 10, year 15, or year 30 because of something called opportunity cost and compound interest. There's compounded costs or compounded effects to the losses.
One other thing I want you to consider is, are they saying you're in it for the long haul? Because when does the long haul end? Or that, you just got to stick with it regardless of what's happening, because that doesn't make sense either. There's a lot of notion around dollar cost averaging, which you just put money in every month, whether it goes up or down, and you'll buy it at an average price as time goes on. But why is it that U.S. Department of Labor says 95% of people are not economically independent at age 65? Yet we have, 70-some million people contributing to 401ks. 401ks are not capable of providing the benefits and promises in retirement, because if you put into it for 30 years, but then you're supposed to take out of it for 30 years, and you're only putting 10% of your income into it, if you're lucky, now that's somehow going to replace your income after inflation. We've been lied to, and turning our brains off and handing our money over has not worked. It's time to invest back into yourself. It's time to question, just like we're talking about fake news and media and everything that Dave's talking about here, what is that in the stock market? What is that coming from Wall Street? And is that really where you want to put your money? Another reason I don't invest in the stock market, and I'll never invest in the stock market again, is there's a lot of misinformation. For one, let's say we've got average return versus actual return. Average return is not what you're actually experiencing, it's just doing math. And math and money don't always equal the same thing. So if I had 100 grand and I lose 10%, I'm all the way down to $90,000. Now, if I earn 10% and I turn on the news and they say, the market's rallied, it's come back, you've earned your 10% back, I only made 10% on $90,000, which means I'm not back to my original $100,000 investment. I'm at $99,000, $1,000 short. But wait, it gets even worse, because they don't refund the fees they charge to manage that money. Right? Even if it's an index fund, there's some degree of fees. If it's inside of a retirement plan, there's also legal fees, admin fees, all sorts of additional fees on top of what you're paying for the funds. And so I might be down at $96,000 because of all the fees that have now come out of the plan. I don't like that type of a situation. I think the economy is too volatile to be risking my capital, and I don't like the notions of, oh, well, dollar cost average. If you haven't heard of the dollar cost average term, all that's saying is put your money in every single month, because sometimes the market's up, sometimes it's down, and you're gonna buy at an average price if you just consistently put your money away. The mantra, invest early, often, and always. Right? Regardless of the outcome, if you're just patient enough, if you just ride it out, it should be okay in the long haul. But let's look, how many people are actually okay in the long haul? When you look at people that are investing their money that are older than you, or if you're a retiree and watching this, did it work out how you wanted? Interest rates have been so low for so long, that's been great for business owners and borrowing money. It's been kind of terrible for those people that are out there going, hey, I'm trying to earn interest for retirement income and be safe with my cash. So that's been part of the letdown. We have tons of retirement planners. They're not thinking about it at this level of depth. They're just looking at what did this investment do over the last 10 years? What is the track record of this investment manager? And because it's synonymous that investing equals putting money in stock, there's been enough marketing and social agreement that so many of us have just followed suit. So if we look at Enron, this company that was a big-time energy company that you'd hear about all the time, it was just fabricating their numbers. They weren't creating actual value. They were lying in order to create false shareholder value, but as soon as everybody knew it was a lie, and once that was exposed, it went from being worth a bunch of money one day to being worth nothing overnight. Because when you're buying on the first end, right, on the IPO, when it first comes out, the initial public offering, there's a value that's set, and it either goes up or down from there. So you can determine whether you want to buy it. After that, you're buying it on the secondary market, either through a mutual fund or through that individual stock. You're buying from someone who's already bought it before, and that's only worth what people are willing to pay for it. Now, if all of a sudden they know it's a lie, they know it's a fraud, they're not willing to pay anything for it. It's only buying on the information that we have access to, and there's so much information out there. There's so many things happening. There's so many degrees removed from what's actually going on versus what's being reported on the news, and we're taking far too much risk. Now, if this was working, that would be one thing, but it's not. It's been a failed financial experiment, a failed financial system, and this is why we're not seeing people become more financially independent. This is why we're seeing people work so hard, take all that hard work and set capital aside in something they don't know or understand, which is highly speculative and risky, and then getting to the place where they don't have time for the money to grow anymore because now it's retirement time and they live a worse lifestyle than expected. That's not a retirement dream. It's a retirement nightmare. I'll give a second example on that. See, if you had $1,000 and you earn 100%, it grows to $2,000. That's awesome. But if the next year it loses 50%, 50% off of 2,000 takes you back to 1,000. That's a 0% rate of return.
And she says, a few years ago, I inherited a stock portfolio that has a total value of approximately $300,000. Okay. I don't understand the stock market, nor do I trust it. Welcome to the club, Michelle. As a retiree.
You just trust it more than not trust it. You know enough now being around me. You're fired up. You're calling your family.
I am. I've been trying to educate everybody I know, and they're just like, well, it's low, so I think I'm just going to buy more. And I'm just like, if someone would have just listened to me a few months ago because of what I've learned from you, you would have been in a better position.
At the top of my lungs. It was October of 2019 where I was like, we hosted a virtual trend summit. We were calling it. I said I was retiring at the end of 2020.
Yeah.
If I was wrong. That's how much of a stake I was putting on it. I was on Fox News with Neil Cavuto, August of 2008, saying the stock market's overvalued. Stop funding your retirement. It's time to move to cash. And people thought I was nuts. And within the next 2 weeks, there was a 14% drop. And then it just went down for 2 more years. Like, I don't know how to predict all this. Let me be clear. I didn't know that real estate market was going to dive as fast as it did in 2008. I thought it was overvalued. But when lending changes, it happens quickly. When a coronavirus happens, things happen quicker than you can predict, even if you have the most brilliant minds on things.
And even what I'm realizing as I continue to learn about all of this is there are so many variables, and you don't know what is going to trigger the downturn.
Right.
And it could just be based upon an emotion or a perception. Like, I fear something's going to happen. So then people panic and make decisions, and there's a massive impact on the stock market.
I read this report one of my mentors sent me. It was from McKinsey, the big consulting group. And they were flat out, I don't know how many years ago it was, but they were saying, We are in for something massive and major on a global scale.
I stopped in 2000 when the market started to go down, and I couldn't explain how long it was going to go down, why it was going down, why these companies were valued at one thing one day and did have a totally different value the next day. I realized was more of a perception and a perspective than it was reality. I don't put money in the stock market because I don't have control over those companies when I buy those stocks. As a matter of fact, if I have 500 companies, I'm not reading all the reports. I'm not excited about everything that's going on inside of those boardrooms. I'm not sure how sustainable their initiatives are. I'm not sure what technology is coming out that could disrupt everything and make that company more obsolete. And so ultimately, I don't like to invest where I don't have knowledge. I call that more gambling than investing. And then when you look at it, and it's failing 9 out of 10 times, that Americans are getting to retirement, yet they're not able to retire off their retirement plans that are fueled primarily by the stock market, something is wrong here. You can go to wealthfactory.com/investing. You're going to find out things in this guide that I'm going to contribute to you on 7 ways to invest like an entrepreneur. That compound interest is not the miracle some say it is. You can figure out, should you pay off your mortgage early or not? And that really depends on who you are. How do you protect your investments so when the market goes down, you don't watch your money go down with it and leave your pocket and go into someone else's, because money's never lost, it's merely transferred. And then how can you be more productive by understanding whether you should invest to earn interest or whether you should pay something off to earn interest? Once again, that depends on you. And once you identify that formula, these are just a few of the resources. By the way, that's one of the 7 resources within this guide, wealthfactory.com/investing. I just want to bring this value to you. I want to help unveil what's really going on in the stock market. Have you question, should you really be investing there? Is it a good investment for who you are?
When we're putting our money somewhere and we don't understand it, we've got to stop calling that investing. The world has marketed to us, whether it's Wall Street or retirement planners, the word investing, and it's first off been collapsed to count savings and investing in the same thing. Savings is we've got money set aside, it's available, it's not earning a high interest rate, it doesn't go down, but it's not going to go up a lot. That's savings. Investing is we're locking it away potentially. It could be volatile, it might have a bigger payoff in the future, there might be certain risks associated with it. But speculation or gambling is when we put money into something that we have no idea. Why would it work? When would it work? How would it work? How does it benefit us? What are the risks involved with it? And if there's no risk management, then it's speculation. And look, institutions do a lot of risk management. Like, first off, if you go get a loan from a bank, they want a down payment. That's risk management. They want an appraisal. That's risk management. They want to see your taxes and your credit score. They want to charge you private mortgage insurance if you don't put enough down payment. They want a lot of information to protect them on the downside. So that way, if you default, they know what the underlying asset is. If you've got a down payment, you've got more skin in the game. If you show that you've had a history of a certain income or a responsibility with your credit score, these are all factors that are risk management. And look, in Wall Street, this is what frustrates me. Interest rates are 0% with the Fed right now. And so now banks can borrow super cheap to nothing, and then they can still lend it out and earn an interest, right? But if they fell like they did in 2008, right, guess who bails them out, Stolba?
You and I,
the
and the rest of the public.
So this is bullshit when people say it takes money to make money. Whose money does it take? Does it really is it the bank's money? No. They have our money that they're recycling out. Exactly. Good word. And then they say high risk equals high return. When we put money in a retirement plan that we think we're taking high risk with growth funds, the person that's the manager, they have responsibilities, but they're getting paid a fee. The company that's issuing them the talent, they're getting paid a fee on the entire portfolio, not on the cash that they put in, but on the portfolio. And if you lose, they still get a fee on whatever is left over. They're not taking high risk to get high return. It's not taking their money to make money. And yet these faulty notions have rigged the game against people. They rig the game against people because first, we neglect cash flow. Second, we take on unnecessary risk that we don't understand the nature of that risk until we have a crisis like we're in today. And then it just frustrates and creates bitterness, right? We have people that have high interest rate loans, yet they're funding their 401ks. Pay off those loans. We have people that are funding 401ks and retirement plans before they've even put 3 to 6 months of their own personal savings or before they've invested to figure out their own skill sets.
Because people automatically put money in the retirement plans and they're just funding the stock market. And we look at how many of these companies are, so overvalued. That's why we see major drops when they happen. But then we print money or we just add to the economy to artificially hold this up. And the reality is, the stock market did extraordinarily well in the 90s, but some people still think it's going to have those double-digit returns moving forward. But I think it's just a kind of a pipe dream. I don't expect that to happen. And yeah, I don't think it's, let's make rash decisions when there's things that drop and immediately go, oh, the sky's falling and everything's over. But it's a time to really check in and say, hey, how do I feel when the market goes down? Do I feel like I have any control? Do I know why it's going down? Do I know why it would come back up? Do I feel like I'm a good investor? Do I know the different stocks that I hold? Or do I know the manager that's in charge of them? Do I know the fees that I pay? Do they waive the fees when I lose money? The answer is no. How long will it take to come back? Because let's say that you lose 10% one year on 100 grand, you're now at 90 grand. Well, the next year they make 10% back, but you only get 10% on 90 grand. So it's only back to $99,000 and you've lost time value of money. You've lost that time, not just your money. And what did it do to your mind during that time? Did you feel, depressed, sad? Did it make you more angry? Did you were more short with your family? Like, you got to think about some of these other factors and think, why is it that investing has become synonymous with stocks? Because that's what people are paid to sell. And let me just ask this question. Like, do you really trust Wall Street? Like, do you think, oh, these are the upstanding citizens of the world? If they opened a daycare, would you send your kids to them? Hell no, because you go pick them up, they'd be like, sorry, we lost 8% of little Johnny today, but toes grow back, right? So I think it's time to ask critical questions. And when there's volatility, people start asking this. But why are stocks valued where they're valued is public perception. What are people willing to pay? Why are they willing to pay that? Well, a lot of times it's not because they've done analysis or they have critical knowledge about it. And a lot of mutual funds have to stay involved in growth stocks, even if they don't feel like it's a good time for growth stocks, because that's the objective of the fund. And if they go against it, they get sued and they have legal ramifications.
It's time to focus instead of diversify. Diversification is diversification in this type of market. It just means everything's getting a haircut, everything's losing, rather than just, a few things. But what if you focused on real deals, things that you knew and understand? Maybe you could buy a business that's at a deep discount. Not maybe in the stock market, maybe a private business. Maybe you wait for a while and you're a real estate investor and you're going to see more deals pop up as cash flows top. But look, I'd be careful. We saw Carl Icahn just shorted the commercial real estate market, which means he thinks it's going to go down. You've got to determine what a good investment is for you and what a bad investment is for you. And if you don't know, stay safe, stay liquid, pay off loans, build up cash flow.
100% back as of Tuesday. The S&P 500 closes at a record, erasing last of pandemic losses. Wall Street clawed back the last of the historic frenzied losses unleashed by the coronavirus as the S&P 500 closed at an all-time high Tuesday. The benchmark index notched.
And why does it close at an all-time high? Why is it valued at that level? How long will it stay? What is your actual growth by the time you pay for fees and have volatility? What's your exit strategy? How do you get to this money? When do you get to this money? And what happens if it remains volatile in the future? What happens if you own a stock that goes out of business? If you're in the S&P 500, not all 500 companies are going to be around 10 years from now because of artificial intelligence, advancement in technology, and that we have a lot more, mobility with smaller companies that can grow exponentially. And there's a lot of major companies that it's very slow moving when they decide they need to make changes. So they have, political policy to deal with. They have major movement to have to, fire workers or hire workers. So I just think that there's a lot more going on than most people know. And we've just heard of so much corruption on reporting and all this kind of stuff. And we don't know what's going on in the boardrooms, but we're just supposed to trust and invest because that's the American thing to do. It's time to turn on your brain, ask some better questions, and determine, how do you project your downside, and is this really the right thing for you, or is it just slowing you down from creating economic independence, because most stocks don't create cash flow, and cash flow is really the name of the game.
I would start considering cashflowbanking.com over the stock market. Cash flow banking from the last 20 years for me has done 5.32%. The stock market has done around 6%. but I'm not losing money right now. And we're not including the negative 2020. So now my cash flow banking accounts, without the risk, without the stress, are outperforming the stock market. Less volatility with a similar net return. Plus, I have access to that cash when everything's on sale down the road to capitalize and buy. Plus, there's tax benefits without locking your money away, like retirement plans. Go to cashflowbanking.com to learn more. You can build up cash to buy in the near future. That's going to be a critical piece. This may not be possible for everyone if you're already in cash crunches. But if it is, look, there's still going to be plenty of deals down the road if you can build up liquidity. But if you think now's the deal, but you're not sure, don't speculate. Too many people are calling and texting and asking if now is the time to buy. If you have to ask me, the answer is pretty simple. It's not. You don't know. Now's the time to focus on cash flow, on economic independence more than ever. Economic independence where you're focused on cash flow and assets that help support your income. It's time to protect your assets. It's time to build up your reserves. Want to continue the path to be a better investor? Make sure that you're not losing money and taking too much risk? Well, click here and learn about strengths vesting.